How do physical commodity futures contracts work? Imagine you want to buy a specific amount of wheat, but you do not need it until next year. How do you lock in today's price? This is where physical commodity futures contracts come into play. These contracts are agreements to buy or sell a specific quantity and quality of a physical commodity at a set price on a future date. These contracts are standardized and traded on regulated futures exchanges. This means that the terms, including the type of commodity, quantity, quality standards, delivery location, and delivery timing, are all predetermined. This standardization allows traders to focus on price rather than negotiating individual terms. When a contract reaches its expiration date, the seller is obligated to deliver the actual commodity to the buyer. The buyer must accept and pay for it. Common physical commodities include agricultural products like wheat and corn, energy products such as crude oil, and metals like gold and copper. However, many traders do not want to take delivery of the physical goods. Instead, they often close their positions before the contract expires. They do this by entering offsetting trades, which allows them to avoid the physical transfer of the commodity. From an investment perspective, physical commodity futures contracts serve multiple purposes. Producers and consumers use these contracts to lock in prices and manage risks associated with price fluctuations in the market. Investors also use these contracts to gain exposure to price movements without needing to own the physical goods. This can help diversify their portfolios and protect against inflation. The price of a futures contract reflects expectations about the future spot price of the commodity. It also includes costs related to storage, insurance, and financing. Traders must maintain margin accounts to cover potential losses, as the value of the contract can fluctuate daily based on market prices. In essence, physical commodity futures contracts create a standardized agreement for future delivery of physical commodities. They facilitate risk management and investment opportunities in the commodity markets. Investors can either hold contracts to expiration and take delivery, or trade contracts to gain exposure to price changes without handling the physical goods.